Host Joshua David, and we are having a great time in the studio talking about the finance. So, Al, as we get into this next segment and this topic, there was a lot of terminology on, everybody's seen what happened this past week in the stock market. We're not going to get into the companies or the brokers or anything. I want to talk about those techniques and concepts that had happened. Now, just some background. We were talking about in the first segment how great this past week was in a down market.
Mm-hmm.
A lot of our listeners are probably wondering, what the heck? Why are they saying everything is so great when the market has been down? But that's one of the problems is the public or the average investor, we'll call it, have been conditioned to just think up is good and bad is down. I want to talk about that because a lot of our listeners are missing these great opportunities. What does it mean? And what is the technique or the concept of benefiting in a down market? It's called shorting.
Mm-hmm.
Explain what that is.
Yeah, well, first of all, just let me make this statement. The pros out there, the smart money, they don't look at any market condition as threatening. It really doesn't make any difference to them whether the market is going up, down, or sideways. There are strategies that can be used and that they do use to participate in all three directions. And the truth is that the strategies they use really are no different than the strategies that are available to us as retail traders. It's just that you haven't been educated on them. Josh mentioned in a down market, how do you benefit? And do you know what the ways are of benefiting in a down market or having the potential to benefit? Because there's at least three ways that you can do that. One is with what we call shorting. And that's a concept that it's a hard concept to understand. And I would suggest you come into one of these classes so we can go into a little more detail on it. But most of you are conditioned to do this. When you invest, you open a position by buying something, and your expectation is that it's going to go up in value. And then when you sell it, you close that position, and hopefully you have a profit there. If you buy it low, sell it high, there should be a profit. In shorting, you're doing the opposite. You are selling at a higher price with the intention of buying it back at a lower price. You're selling something that has been loaned to you by a broker, so at some point in time you have to return it. So your goal is to sell it high, buy it low. It's just the opposite of what most of you have been doing. That's a concept that can be used in a market that is going down. That's something you can't use in an IRA, but there are other things that you can do.
Just to elaborate, Al, I know you got some more to talk about, and you don't have to find somebody to do that. The brokers have shares
Exactly
that they technically loan, but you don't even see it. It's all done behind the scenes.
Exactly.
So just think of it this way: if you think the market's going to go down, you short. It's just a click of a button on a platform, and then you close your position after it has dropped in price. The difference is the profit there. So say you sell it short at 100, you close your position at 90. That's a $10 profit. That's what that concept really means.
Exactly. You're benefiting in a positive way for you, regardless of whether the market's going up or going down. You're just doing it in a different direction. It's easy when you buy something now with the way the platforms are set up is basically just pushing a button. And the same thing is true of shorting. But we'll go into more detail in these classes so you understand it. That's one way of benefiting or having the potential to benefit in a down market. There are option strategies that will do the same thing, and what we call inverse ETFs. An ETF is an exchange-traded fund, similar to a mutual fund, except you don't have the expenses there, and it trades like a stock. So you can buy and sell it during the day. And there are inverse ETFs that go the opposite direction of what they are designed to follow. For example, in the S&P 500, the inverse would go the opposite direction of the S&P 500. Those are things you can use in a retirement account.
Yeah, those are some great concepts because, a lot of people are missing out on these opportunities. That's the fact. No, another fact is it's a learned skill.
Sure.
And that's why you teach a lot of these investing classes. They're really introductory classes for people that want to learn more really about how the stock market really works. What are some of those techniques and concepts that the institutions use, or the smart money we call it?
Right.
These are actually available to us. Al, so now that our listeners understand why we're talking about these down markets being so great. Now, some of the different assets the institutions are using to create income may be new for some people as well. So everybody knows the stock market. That's all they talk about on TV. That's all they talked about this past week on TV.
Right.
Now, there's the futures market, and there's the Forex market. Why are these such great markets for us as the public to utilize, I guess, any time of day?
Yeah, well, there's really two components to your investing world, and one is a kind of a foundational strategy that you use to identify the right place to get into or out of a position. That's really key. That's important, no matter what asset you're trading, no matter what your time frame is. If you even want to be a day trader, or maybe you only want to invest once or twice a year, that same strategy should apply in all conditions. And then the second part of it are the assets, the right assets to use. Look at that as kind of being when you're playing golf, that's your bag with a number of different clubs in it.
Hmm.
And, I think I've asked you this before. If you were playing in a tournament and you had a choice of playing against somebody who had never played before but went out and bought a great set of clubs, or you could play against somebody who had taken lessons from a pro, played with the pro, and then had those great clubs, who would you rather play against?
Whenever I go to Legends, you always see that one or two guys that have all the great clubs, all the great clothing, nice hats and everything. They are always the worst golfers. So I would rather play against them.
Yeah, right. A brand new bag, maybe even still has a price tag on it.
Probably, yeah.
Yeah. Well, yeah, and the point there is that the clubs don't make any difference unless you know how to use them. And the same thing is true in investing. There are different investment vehicles, sort of clubs, like when you're playing golf, that are applicable to different situations. You don't tee off with a driver. I mean, with a putter. You tee off with a
Correct.
driver, and you don't putt with a driver. You use the appropriate club. And the same thing is true in the markets. Unfortunately, Wall Street is not giving you that full bag of clubs to use. They're basically telling you, even though you might come in and say, look, I need to generate some additional income now. I need some additional cash. They're going to tell you, the brokers, the financial advisors will tell you, hey, we're going to look at you specifically and put together a plan for you. And then typically, and again, this is not all of them, but most of them will put you into the same type of strategy, which is not short term, it's long term. You're told to hold on to things. Don't worry about these corrections or crashes. Don't worry about, like this last week when we had 2 days where the market was down over 600 points, or in 2008 when the market was down 57 points or percent. They tell you, don't worry about that because the market always comes back. That is not the proper way to generate cash on a short-term basis. There are assets that are more appropriate. That Josh mentioned, Forex, futures, options. Those are vehicles that can be used in short-term trading styles. Futures is a great short-term trading vehicle because typically or often you will be in and out of a trade in a day or so. You're trading a number of different markets there. So you have a lot of variety, a lot of choices that actually can help you put together a truly diversified portfolio. You can trade the stock markets. You can trade commodities, oil, gold, silver, currencies, interest rates, trading almost 24 hours a day.
You forgot my favorite.
Lean hogs.
There
We
you
can't
go.
forget lean hogs. And with leverage. And that's the important part is the leverage. And that really is the backbone of some of these assets is the leverage it provides. It allows smaller account sizes to control a much larger overall investment. It allows people that don't have a lot of money to participate in markets that they might normally be able to participate in.
Yeah.
Forex, the same thing. With great leverage, trades 24 hours a day. There you're looking at the difference in exchange rates between two different currencies. You're trading globally. When you think about it, when you go to bed at night, Josh, does that mean all the markets in the world have to shut down?
That is not.
That's not the case. They're open. Basically, there's a market open 24 hours a day somewhere. So you have much greater opportunities to participate. Plus, you have the ability when something is open 24 hours to do a better job of managing the assets that you have.
Yeah, and think about that. If people are working during the day, we'll say stock market hours, these assets are available in the evening. They're open around the clock. I mean, when I was talking about these other markets opening, essentially, like say when it's 2 a.m. our time here in Minneapolis, it's 8 a.m. in London. So they're up and at 'em for the day. So the markets don't close. They're open around the clock. So that gives us, the average person or the average investor, the opportunity to trade and invest when we dictate that. So it's a couple of other things too, is the leverage. You're more capital efficient. So that way, say you want to use like a down payment to control a much larger asset. That's what leverage is, very similar to a mortgage.
Exactly.
And the brokers allow that. So that's why it's important to utilize your capital wisely. Al, we've talked a little bit about I guess you call it the shorter term trading assets. I want to talk more about the longer term. I want to put Forex in with that because
Sure.
we have a lot of people that want to understand how can they participate in the markets even if they do work during the day. So let's
Sure.
talk about those longer term strategies coming up next. This is Josh and Al, Investing with Confidence. We'll be right back.